and welcome grade 12 accounting learners. Are you guys ready for another accounting lesson? Of course you are. In today's lesson, grade 12s, we're going to be looking at or focusing on company interpretation of financial statements. Now remember guys, at this point, we've already completed our financial statements, our income statement and our balance sheet. We're now going to be using ratios to interpret, to understand these financial results a bit more better. So when we talk about interpretation of financial statements, we're simply referring to ratios. Right, calculation of ratios as well as commenting on these ratios. Right, remember guys, there we go, that's better. We're now looking at your ratio analysis. Right, ratio analysis. Remember guys, here we are calculating, and sometimes or most of the times we are asked to comment on our calculations or on ratios that would have been given to us. Now, in terms of your ratios that we expect you to calculate in grade 12, we can classify these ratios. We can actually put them into little boxes because there are different types of ratios that tells us or gives us different kinds of information. So if we look at the classification of your ratios, we're going to use the following categories in terms of your classification. We first have your profitability ratios, and these calculations indicate how profitable the business is and how well expenses are controlled. In other words, we are now analyzing, we are trying to interpret the results from our income statement. Because remember guys, what is the purpose of your income statement? Income statement is drawn up to determine whether the business has made a profit or has the business made a loss. In other words, looking at this term profitability, profit or loss of the business. How well were expenses controlled? Are your operating expenses way too high in relation to sales or in relation to net profit and so on? The next category, ratios that fall under returns. Now, when we talk about returns, here we're looking at what the owner or the owners are getting back in return for their investment. In other words, we are concentrating or we are focusing on shareholders. Remember, as a shareholder, you made a choice to buy shares in a particular company, to invest your money in a company, buying shares instead of choosing an alternate investment. So you could have been faced with two options. Either I buy shares in ABC Limited, or I take my money and I invest it in a fixed deposit. Now, the key factor or the key indicator for your shareholders would be the return. What am I getting back out of this investment? The next category focuses on liquidity. When we talk about liquidity, here we're looking at the ability of the business to pay its short-term debts. Short-term debts, we are referring to your current liabilities. Can the business meet its short-term obligations, pay off its current liabilities? The next category is solvency, and under solvency we just have one ratio which we're going to look at in a bit more detail, but solvency itself shows us or is an indication of whether the business can settle all its liabilities. And you guys are going to find, especially when you work through past papers, that there is a key focus on the difference between liquidity as well as solvency. Liquidity, can I pay or can the business pay its short-term debts or its short-term liabilities. Solvency, can the business pay all its liabilities? In other words, its total liabilities, current and non-current, or current and long-term. The next category, or the last category that we're looking at, is risk. Risk indicates the degree of financial risk. Here we're obviously referring to the business itself. Remember, the business takes certain risk when they, for example, borrow capital. So if I've got a non-current liability, in other words, I've taken out a loan, it is considered to be a financial risk, and you normally have your ratios that looks at whether it was worth the risk or not. Right, still with ratios, how can ratios help us? When we talk about us, we are referring to the users of these financial statements. So whether it's a shareholder, whether it's the directors, whether it's the bank or your creditors, how do ratios help the users of financial statements to make certain financial decisions? It helps us to firstly check whether there is growth. In other words, the business is obviously growing, or stagnation in the business. Ratios also helps us to check results with our competitors' performance. In other words, we're taking our results and comparing it to our competitors. So an example would be Spar versus maybe Pick n Pay. Okay, two companies that obviously sell same products, similar products, and they are comparing their performances. Compare current results to previous years, current results to your previous year. So for example, I'm comparing my 2012 financial statements to my 2011 with the help of ratios. Comparing results to alternate investments. Here we're obviously looking at your shareholders. And remember, the shareholder was obviously faced with the decision of, should I invest my money in shares, should I purchase shares, or should I take my money and invest it in a fixed deposit? And then we've got determine the degree of financial risk by the investors, again your shareholders, as well as by your creditors who maybe gave the business a long-term loan. In other words, what was the risk factor that was involved? Right, if we now still on ratios, we're now looking at some people that are interested in measuring the business results. In other words, again, guys, we're looking at the users of this information, of your ratios itself. Management, here we're referring to your directors, because remember, they want to obviously know how well the company has performed under their management. The owners, here we're obviously looking at your investors, specifically your shareholders. Then we have other users being your banks, whether they can grant the company an additional loan or not based on the information, based on the ratio analysis. SARS, receiver of revenue, is interested in interpreting your financial results. Trade unions, is the company being fair to its workers in terms of the salary and wage that the company is paying? Remember, guys, they normally, or trade unions normally compare the increase in salary and wages to the profitability of the company itself. And then finally, your competitors, they also want to keep an eye on your business. They want to know how well your business has done. Right, let's now look specifically at the different types of ratios, and let's now place them into these categories that I've spoken about earlier on. Our first four ratios, we've got gross profit on turnover, gross profit on cost of sales, then we've got net profit before tax on turnover. And remember guys, whenever we talk about turnover, we are talking about sales. Total expenses on turnover. All four ratios fall under profitability. And remember guys, I mentioned this earlier on, when we're going to do the actual calculation itself on profitability ratios, we're going to refer to your income statement. Then the next set of ratios, under the category solvency, there's just one ratio, and it is called your solvency ratio. Remember, solvency is the business able to pay its total liabilities. In other words, total assets being compared to total liabilities. That's just one ratio that falls under solvency. Then we've got something that's very often tested in your exam, the category of liquidity. Now, under liquidity, you're going to find that we've got 6 liquidity ratios, and all of these ratios, grade 12s, are absolutely important. We've got under liquidity your current ratio, your asset test ratio, rate of stock turnover, number of months of stock on hand, your debtors collection period, in other words, how long your debtors are taking to pay their accounts, and then the last one under liquidity, your creditors payment period, how long are you taking, you as in the business is taking, to pay your creditors. The next ratio, absolutely important, gearing ratio. Gearing falls under the category of risk. Here we're simply looking at just one ratio, debt equity ratio. Now please remember, grade 12s, in the exam, sometimes they refer to it as gearing. They actually ask you to calculate the gearing ratio, or they may tell you calculate the debt equity ratio. It means the exact same thing. Debt equity ratio. Right, the next set of ratios is on or falls under the category return. We're looking at your return on shareholders' equity, return on capital employed, earnings per share, very, very important ratio, dividends per share, just as important, and then the net asset value per share. Net asset value per share, in other words, what your shares are currently worth. Right, so in total, guys, 17 ratios that you need to learn. You need to know the formula. You need to know exactly how to calculate these ratios. Right, what we're going to do now is we're going to quickly look at some of these calculations, the formulas for the ratios itself. And what I want to do is quickly go to your solvency ratio, because remember I mentioned solvency, a very, very important ratio, often tested in your exams. Right, if we look at the formula used to calculate solvency, here we are comparing our total assets is to total liabilities. So for example, your total assets might be an amount of 400,000. We are comparing 400,000 to total liabilities. It could be an amount of 200,000. Right, now remember guys, the word total means that we're looking at current plus non-current. And for your total assets, total liabilities, we're going to go to the balance sheet. We're going to refer to the balance sheet. Our balance sheet obviously shows us or gives us all our assets, our total assets, as well as all our liabilities, our total liabilities. So if, for example, again, your total assets, 400,000, compared to your total liabilities, 200,000, ratio analysis calculations, always remember guys, the right hand side must equal to 1. So if I need to make the right hand side equal to 1, I am dividing the right hand side. In other words, my total liabilities, I need to divide this by 200,000 200,000 divided by 200,000 is obviously going to give me the 1. Whatever I do on the right-hand side, I must do on the left-hand side. So if I divide 200,000 on the left-hand side, I'm doing the exact same thing, dividing by 200,000. 400,000 divided by 200,000 gives me a ratio of 2:1. In other words, how do I interpret this? How do I read this? For every 1 rand owed, for every 1 rand in terms of total debt owed, the business has 2 rand worth of assets to pay towards that liability. When we are commenting on this calculation, let's just quickly look at some kind of guidance. When you are commenting, the ratio is used to answer the question whether the business is solvent. Solvent is an indication of its solvency situation. In other words, if the business had to shut down and sell all its assets, will the business be able to pay off all its liabilities? If assets are more than liabilities, the business is considered to be solvent. Okay, so in the example that we've just seen, if my assets were 400,000, my liabilities are 200,000, can you see the business can obviously pay off its total liabilities once they sell their total assets. The higher the ratio, the better it is for solvency. So please remember that. If solvency is close to 1:1, there is a possible risk of insolvency in the future. So in other words, if we calculated this ratio, and if, for example, we've got 0,9:1, immediately, can you see there's obviously going to be a problem should the business shut down, because for every 1 rand owed, there is only 90 cents worth of assets. So remember, guys, solvency, the higher the ratio, the better it is for the business. What we're going to do now is take a quick break, and when we come back, we're going to look at a question on financials, on company financial interpretation. In other words, look at a question on ratio analysis. Okay, so quickly go and get something to eat, and when you guys come back, we will then look at a question. Welcome back, grade 12s. If you've just joined us, you're just in time, because we are about to begin with a question on ratio analysis. So let's not waste any time. Let's start with our question. Question 1. Interpretation of financial information. You are provided with information relating to Baga Toys Limited. Before we look at the required or what we need to complete, let's now go to our information first. Your information. The following information was extracted from the income statement for 2008. So they're giving us an extract from the income statement for the year 2008. We've got cost of sales given to us. Below cost of sales, interest on loan, and in brackets they tell us the interest is 13% per annum. So I'm just going to circle that 13% because I might need that rate at a later stage. Net profit before tax, and below net profit after tax. Right, let's move on. The next bit of information that they've given us, information 2. The following financial indicators were calculated for the past 2 years. Now, please remember, grade 12s, whenever you come across a question on ratio analysis, they will always give you information, especially from the balance sheet, for the past 2 years. Past 2 years, we are talking about the current financial year as well as the previous financial year. So let's now go to these financial indicators that have been given to us. So we've got 2008, 2007, 2007 being our previous financial year, and then 2008, obviously, our current financial year. Let's now look at the ratios or the indicators that have been given to us. Starting off with current ratio, So 2008, 4,1 is to 1. 2007, 2,1 is to 1. So immediately, I'm sure you can see there's been an increase in your current ratio. From 2,1 is to 1, it has increased to 4,1 is to 1. Then your asset test ratio. 2008 is not given to us. So somewhere in the question, I'm assuming they're going to ask us to calculate the asset test ratio for 2008. 2007 is given to us, 1,3 is to 1. Next ratio given, stock turnover rate, again, 2008 missing, we probably have to do a calculation. 2007, it is 8 times per annum. Debtors collection period is the next ratio given to us. 30 days for 2008, 2007 also 30 days, so it has remained the same. And there's absolutely nothing wrong with that, because remember, your debtors are normally given 30 days to settle their accounts. So obviously the debtors are doing quite well. The business has kept tight control over their debtors. Creditors payment period is the next ratio. We've got 2008 calculated at 90 days, 2007, 60 days. So here we're obviously taking a bit longer to pay our creditors. Now, before we look at the next set of ratios, immediately, guys, we spoke about this. I spoke about this before the break. If we had to put this into a category, the first 5 ratios that is given to us in the question is our liquidity ratios, L for liquidity. Let's now move on. The next ratio, we've got debt equity ratio. And remember, another word for debt equity ratio, they often refer to this ratio as the gearing ratio. 2008, not given to us. 2007 is given to us, 0,1 is to 1. So immediately we can see that this business is low geared. They don't rely that much on borrowed capital, because for every 1 rand of own capital, there's 10 cents of borrowed capital. So the company is low geared. Right, your debt equity ratio, I just want to quickly change the color of my pen there. This ratio is, if we had to place it into a category, it falls under risk. Let's move on. We then have our percentage return on average shareholders' equity. So we've got 2008, 33 and a third, or 33,3%. 2007, it's 25%. So again, there has been an increase in your return. And remember, guys, if there's an increase in return, your shareholders are extremely pleased about this. Next ratio, percentage return on total capital employed before tax. 2008 calculated at 44,3%, 2007 25,8%, and again we see there's been an increase in return if we compare 2007 to 2008. Net asset value per share, 2007 not given to us, 2008 is not given to us, 2007 given to us at 213.6 cents. Then we've got market value per share. Now I just want to quickly use a different color here, and I just want to circle this word market value. Whenever we talk about the market value grade 12s, here we're referring to what the shares are trading for on the JSE. Okay, so I'm just going to make a little point or a little note there, so that when we do come back to this ratio, we know market value is referring to the trading price of the shares on the JSE. So again, if we just quickly inspect the market value per share, 2008, 240 cents or 2 rand 40 cents. 2007 shares were trading at 220 cents. Again, there's that upward trend, an increase in the market value per share. Dividends per share, our next ratio, let's just go back to another color. Dividends per share, we've got 2008, 20 cents, 2007, 10 cents. So again, shareholders have obviously received more dividends for the 2008 financial year. And then finally, earnings per share is our very last financial indicator that is given to us. 2008 not given, so we're going to have to calculate this at some point in the question. 2007 given to us at 55.2 cents. Right, so immediately, let's just put this into a category like we did for the rest of the ratios. So if we look at your return, as well as the following four ratios, your net asset value per share. Let's leave out market value per share. Let's look at dividends per share, earnings per share, and then we've got your 2% returns. This falls under the category of returns. Okay, your category being, just get a pen there quickly, your category of returns. Okay, in other words, ratios that your shareholders are interested in. They've invested money in your company or in the company itself, and they're now interested in these ratios because it tells them a bit about the returns. What are they getting out of this company? Right, let's move on to the next bit of information that is given to us. Okay, there we go. Our next bit of information is our balance sheet given to us. And again, we've got the balance sheet for 2008, which is our current financial year, as well as 2007, which was our previous financial year. Right, the balance sheet, they've given us an entire balance sheet, and as we scroll down, okay, we've got our assets listed. Then, very quickly, equity and liabilities. Ordinary share capital, I just want to draw your attention to the following grade 12s. Ordinary share capital, 2 Rand par value, and this is obviously the capital itself. Right, now remember, 2 Rand par value, this bit of information is absolutely important because you are going to be required at a certain stage in one of the questions to work out the number of shares. So I'm just going to put a little reminder that we're going to obviously use this later on. We're going to come back to this information. Then share premium is fine. They've given me retained income. We then get to our liabilities, mortgage loan, and again, there's that interest rate that is important, 13% per annum. If we quickly look at our non-current liabilities, 2008, 150,000, 2007, 200,000. So there's obviously been a decrease in your liabilities, your non-current loan, non-current liability. Then current liabilities given to us as well. Right, we're now ready, grade 12s. We've looked at the information. Let's now go to the question. Let's look at what is required for us to complete in this question. 1.1. A company's published annual report comprises of 5 main parts. Okay, so they're talking about the annual report. It comprises of 5 main parts. Now, before we even read on grade 12s, very quickly, let's do a quick recap on the annual report. Remember, every company, it is a requirement by the Companies Act that they publish an annual report. What makes up this annual report? It is your 3 financial statements. Okay, financial statements. Here we're talking about your income statement, your balance sheet, and your cash flow statement. So the annual report is made up of 3 financial statements as well as 2 reports. Okay, what reports are we talking about? We are talking about your directors' report, where the directors tells the shareholders about the operations of the business for the year itself, as well as the auditor's report. The auditor's report and external report. So you've got your 2 reports together with your 3 financial statements that makes up the annual report. You are required in this question to match the components of the annual report in column A with the description that is given to you in column 2. And they tell you the first one has been done for you. We're not going to look at that. Let's just go straight to our description, and let's try and match our description to the component of the annual report. So let's start with the very first description, description A. This is a written verbal explanation of the operations of the company during a financial year. So it's a written verbal explanation. Remember, the directors are responsible for running the company. They run the company on behalf of the shareholders, and they need to therefore provide a written verbal explanation to their shareholders on the operations of the company. So A is a description of your director's report. Okay, so we've dealt with director's report. Let's now look at our next description, B. This reflects whether or not the shareholders can rely on the financial statements. Right, can the shareholders rely on the financial statements? Remember, an auditor needs to provide a report to the shareholders on whether the statements fairly present or don't or does not fairly present the financial position of the company. So here we're obviously looking at your audit report or your auditor's report. Right, so auditor's report, we've dealt with this. Let's now look at our next description, C. This reflects the profit or loss of the company for the year. Right, what statement gives us either a profit or a loss? In other words, this statement calculates whether the business has made a profit or loss for a financial year. Absolutely spot on correct. Here we're talking about your income statement. Income statement reflects the profit or loss of the company for the year. So we've dealt with income statement. Now let's look at D. This reflects the effect of operating, financial, and investing activities on the cash resources. So here we're obviously talking about the flow of cash, inflow, outflow of cash. Yes, absolutely correct, grade 12s. We are talking about your cash flow statement. Okay, so there we go, cash flow statement. And then finally, the last description, yes, I know it is a balance sheet, but let's quickly look at the description. This reflects the net worth of the company. Net worth, immediately we are talking about a balance sheet. Okay, so 5 easy marks. Annual report made up of income statement, balance sheet, cash flow statement, director's report, and then you've got your independent auditor's report. Let's move on to our next question. For the next question, we are referred or we are asked to refer to information 1, 2, and 3. At the end of this question, we are required to calculate the following financial indicators for 2008. So we're going to be calculating the asset test ratio. Then we've got stock turnover rate. Thereafter, we're going to complete or calculate the debt equity ratio, net asset value per share, And then finally, we're going to calculate earnings per share. So we're going to have to do some ratio calculations. So let's now start. Let's do our first calculation, our asset test ratio. There we go. Asset test ratio. And remember, we're calculating this ratio for 2008. Right. Guys, please remember, your formulas you need to know. You need to know exactly how to calculate a ratio. If you do not know the formula, obviously, grade 12s, you are not going to be able to complete this calculation. So let's now start asset test ratio. What is the formula? The formula is, we are looking at current assets minus your stock or inventory, and we are comparing this to your current liabilities. Right, where do we get this information from? Current assets, stock, current liability is found in my balance sheet. So let's now go to the balance sheet and let's now look for our current assets. Okay, there's your balance sheet, and we're now looking for our current assets. There we go. 2008, that's our current assets. We obviously need inventory as well. So there's our inventory amount, 99,500. And thereafter, we also require our current liabilities. If we look further down, there's our current liability amount. So those three amounts is going to help us to calculate the asset test ratio for 2008. So let's now do this calculation. Our current assets is an amount of, there we go, 248,500. So current assets, 248,500. We are subtracting our inventory or our stock. So let's go back to our balance sheet. There's our inventory, 99,500. So minus 99,500. And we're going to be comparing this to our current liabilities. So again, back to our balance sheet. Current liabilities, there's my amount, 60,500. Right, let's now complete this ratio. Let's take our calculators out. Okay, so we are taking our current assets, 248,500, and we are subtracting our stock amount, which was 99,500, to get 149,000. Okay, so let's fill that in, 149,000. Again, comparing it to our current liabilities, 60,500. Remember, whenever you are doing a ratio calculation, the right-hand side must always equal to 1. So I'm going to divide by 60,500. Whatever I do on the right-hand side, I've got to do on the left-hand side. So divide by 60,500, and I'm ending up with, again, if I take my calculator out, divided by 60,500, I'm ending up with, there we go, 2,46. Okay, so we've got a ratio of 2,46, or if we round this off to 2,5 is to 1. Okay, are we all happy with that calculation? Easy calculation, 4 marks. As long as you know your formula, it's very easy to then find the amounts from the given information. Right, let's now move on to the next ratio that we're going to have to calculate. And this is now our stock turnover rate. So another liquidity ratio that we've got to calculate. Stock turnover rate, again, formula, something that you've got to know, grade 12s. Stock turnover rate, we are looking at, for 2008, cost of sales divided by our average stock. Right, my cost of sales. Where do I get my cost of sales? Cost of sales, we're going to find cost of sales in your income statement. And average stock, we're going to find our average stock, not average stock, but stock in the balance sheet. Okay, so let's now go to our income statement. Let's look for our cost of sales for 2008. So back to our information, don't need the calculator. Okay, so we've got the balance sheet. Let's quickly go to your income statement. There we go. So you've got an extract of the income statement. There's my cost of sales amount, and this is the amount that I need for my ratio calculation, 976,000. So let's take that to our calculation. Cost of sales is an amount of 976,000. We're going to divide this by average stock. How do we calculate average stock? Average, remember you're looking at half of. In other words, we're going to divide by 2 your stock for 2008 plus 2007. So we need to go to our balance sheet. Let's go to our balance sheet quickly. There's our balance sheet, and we're now looking at inventory. Trading stock is inventory. There's our inventory. 2008, our inventory on hand, 99,500, and then we've got 2007 inventory amount of 62,500. So we're simply taking these two amounts, adding them together, dividing by 2 in order to get an average inventory or average stock. So let's now do this. Okay, so if we go to our answer sheet, 2008, our stock amount was 99,500 plus 2007. Let's quickly look that up. There we go, 62,500. 62,500. Okay, right. Let's quickly do our calculation. So we've got 976,000 divided by, let's get our calculators out. So we're looking at 99,500 plus 62,500, and that gives us 162,000, but we want an average, so we're going to divide this by 2 because we're obviously looking at 2 years. So our average stock is an amount of 81,000. All right, let's take that through 81,000, and we now can calculate our stock turnover rate. So again, on our calculators, we are taking our cost of sales amount, which was 976,000. We are dividing this by our average stock, which we just calculated, 81,000, to get, okay, an answer of 12 times per annum. Okay, so the answer is 12 times per annum. Let's just fill that in. 12 times per annum. There we go. Okay, ready now to move on to your next calculation. We're now looking at your debt equity ratio. Debt equity ratio, remember guys, we're referring to your gearing ratio for 2008. Gearing ratio, we are comparing debt to equity. Simple as that. We're looking at your debt, comparing it to equity. What makes up debt? Here we referring to your non-current liability. Equity, we all know equity for companies, we're referring to your shareholders' equity. Okay, both these amounts will be found on the face of the balance sheet. So let's go to our balance sheet. Okay, there's our balance sheet. Let's start off with our non-current liabilities. Your non-current liabilities for 2008, sitting at 150,000. And then your ordinary shareholders' equity is sitting at 1,657,040 rand. So these two amounts will be taken in order for us to calculate our debt equity ratio. So let's go back to the answer sheet. Our non-current liabilities was an amount of 150,000. Let's fill that in. Our shareholders' equity from our balance sheet is an amount of, let's go back to the balance sheet quickly. There we go, there's that amount there. Okay, was an amount of, let's fill it in, 1,657,040 rand. Okay, again, I'm going to divide my right-hand side by 1,657,040. Whatever I do on the right-hand side, I'm going to do the same on the left-hand side. Divide by 1,657,040, and I'm going to end up with a ratio of 1. On the right-hand side, let's take our calculators out. Okay, so we've got 150,000. We're going to divide this by 1,657,040 to get, okay, 0,09. Okay, so 0,09. Right, and as we can see, the company obviously not relying that much on borrowed capital. Right, let's move on to our next calculation. We're now looking at net asset value per share. Net asset value per share, what are your shares worth? Let's now look at the formula again. We must know the formula, because if we don't know the formula, we're not going to be able to complete this calculation, and we're going to lose easy marks, guys. Net asset value per share, here we are looking at shareholders' equity. Shareholders' equity, we came across this amount in the previous calculation, divided by number of shares issued. Right, shareholders' equity, simple. We came across the amount, it's in our balance sheet, easy for us to pick up, but number of shares issued, this was not given to us in our balance sheet. In other words, we've got to do a calculation for the number of shares issued. So let's do that calculation first before we work out our net asset value per share. So we're going to go back to our balance sheet, and we are looking at our ordinary share capital. Okay, there we go, ordinary share capital. 2008, our ordinary share capital sitting at 1,525,000. And in brackets, we've got your shares have a par value of 2 rand. So if we're going to calculate the number of shares issued, grade 12s, all we're doing is taking our capital amount, and we're going to divide this by our par value of 2 rand. So let's do that quickly. Okay, so there we go. Our capital amount was 1,500,000. Let's just go back there. What was it? 1,525,000 divided by a par value of 2 rand to work out how many shares were actually issued. Okay, so let's get our calculators out. So 1,525,000. Going to divide that by 2 rand, and this company had issued 762,500 rand shares. So let's fill that in. 762,500 shares. Okay, now that we know the number of shares that were issued, we can complete this ratio or this calculation. So let's go back. Let me just change my pen quickly for you guys. Right, so we're going back to shareholders' equity for 2008 divided by number of shares issued. Number of shares issued, we've just done the calculation, 762,500 is the number of shares issued. Shareholders' equity, we've got to go to our balance sheet for that. And there's our ordinary shareholders' equity, this amount here that we came across in the previous calculations. So let's take that through. Okay, so we've got this amount of 1,657,040. Okay, let's just go further down. Right, in order to complete this calculation, guys, please remember your answer needs to be in cents or in rands. I'm going to prefer for the answer to be in cents, so I'm just going to add on times 100 cents so that my answer is in cents. So let's now do this calculation. There we go. So we're simply taking 1,657,040. We're going to divide by the number of shares, 762,500, to get the net asset value per share, which if your answer was in rands, it would be 2 rand and 17 cents. But we want our answer in cents, so we're going to times this by 100 to get 217.3 cents. So let's fill that in. Okay, 217.3 cents. Okay, simple, easy marks, guys. Right, let's look at the next calculation. Is there another calculation? Yes, there is. Earnings per share. Okay, earnings per share again. We are calculating this, just a reminder, for 2008. Your formula to calculate earnings per share, here we are looking at net profit after tax divided by number of shares that were issued. Okay, number of shares issued, we did this calculation in the previous question. Net profit after tax, where am I going to get this amount? Okay, absolutely correct. I'm going to get this amount from my income statement. So let's now go to your income statement. Let's look for your net profit after tax. Okay, income statement, there we go, net profit. This is your balance sheet. Let me find the income statement quickly. Right, there's my income statement, and I'm looking for net profit after tax. Okay, there's my net profit after tax, an amount of 525,000. So let's go back to our answer sheet. So my net profit after tax is equal to 500 and, what was it, 25,000. Divided by number of shares issued. We've done this already, so let's just go back to our previous calculation. Number of shares issued, we calculated it at 762,500 shares. That was your number of shares issued, so let's fill that in. Number of shares issued, 762,500, and again I want my answer in cents, so I'm going to times this by 100 cents. Okay, let's get those calculators out. So we've got 525,000 divided by your number of shares, which is 762,500. Okay, and we're now going to times this by 100 so that our answer can be in cents. And that gives us 68.9 cents. So let's fill that in. Okay, 68.9 cents. Okay, right. Let's move on, guys. Okay, now the next question, before we look at question 1.3.1, what I want to do very quickly, we've calculated or we've completed I think it was five ratios for 2008. All I want to do is I want to add, or I want to go back to our information, and I want to slot these figures in so that when I start comparing, when I start analyzing these ratios, because I'm going to have them side by side, 2008 and then next to it 2007, it makes it much more easier to compare, to analyze. So let's now quickly do that. If we go back to our question, okay, we're going to our information. Right, there's our information on our financial indicators. So all I want to do now is quickly slot in the calculations that we've just made. So starting with our acid test ratio, if we quickly go back to our calculation, there we go, it was 2,5:1. So let's just quickly slot that in, 2,5:1. Your stock turnover rate, if we go back to our calculation, stock turnover rate, if I remember, I think it was 12 times per annum. Yes, it was. So let's now slot that in. So it's 12 times per annum. Okay, next ratio, the debt equity ratio. So again, let's go back to our calculation. Debt equity ratio was calculated for 2008 at 0,09:1. So let's fill that in as well. Debt equity ratio 0,09:1. Right, and then I think we've just got two more to go. Net asset value per share. So back to what we calculated, the net asset value per share at 217.3 cents. So let's fill that in, 217.3 cents. Okay, as you can see, guys, once we fill it in, we can easily compare this to 2007. And then finally, earnings per share was the last calculation that we completed. Earnings per share, an amount of 68.9 cents. So let's fill that in. Earnings per share, 68.9 cents. Right, we're now ready to move on to our next question. So let's go to the question. Right, our next question reads as follows. They want us to briefly explain the difference between solvency and liquidity. Now remember, guys, I spoke about this earlier on. Very, very important that you know the difference between these two ratios. What is solvency? What is liquidity? So let's now start looking at or recapping on these two categories of ratios. Let's start with liquidity. Now, when we look at liquidity ratios, we are looking at whether the business is able to pay its short-term debts. In other words, can the business meet its short-term obligations? So liquidity, if I had to explain liquidity, is the company or the business able to pay its short-term liabilities. Okay, let's just fix that. Short-term liabilities. Now remember, when we talk about short-term liabilities, we are talking about current. Can the company pay its current liabilities? Like, for example, your creditors, your bank overdraft, your short-term loan, current liabilities. So that's what we mean by liquidity. Let's now look at solvency. What do we mean by solvency? Just want to change the pen quickly. When we talk about solvency, here we are referring to, can the business pay off its total liabilities after selling its total assets. So we're simply comparing total assets is to total liabilities. So solvency, a definition or an explanation of solvency is the business able to pay its total liabilities? And remember, when we talk about total liabilities, grade 12s, here we are referring to, just want to quickly change the pen again, here we are referring to the word total refers to current plus your non-current liabilities. So in total, your total debts, that would include your creditors, your bank overdraft, your mortgage loan, any other non-current or your long-term liabilities. So that is the difference between the two. Please make sure you know this difference. Okay. Right, so we've now just explained the difference between solvency, looking at total debt, versus liquidity, focusing on current debt or current liability. Let's move on now to our next question. Your next question reads as follows. Comment on the liquidity situation of the company, and then they want us to quote 3 relevant, the word relevant, financial indicators, in other words, your actual ratios or percentages to support your answer. Okay, now remember, here they're asking you to comment on liquidity, and when we were going through the question earlier on, we found that there were 5 liquidity ratios that were given to us for 2008 and 2007. So let's now go back to those financial indicators, briefly analyze those liquidity ratios, and then comment on liquidity. In other words, can the business pay off its current debt, its current liability? So let's go to the question or the information, and remember, we are now looking at financial indicators, and there we go. There's our liquidity ratios. Okay. Right, we are looking at these 5 ratios. Liquidity, it's just these 5 ratios given to us. So if we quickly look at these 5 ratios, our current ratio increased. So it was 2,1:1. It has increased to 4,1:1. Now, immediately you would probably say that, yes, it has increased, but if we look at this ratio, it's probably a bit too high. In other words, if you compare your current assets to liabilities for 2008, okay, for every 1 rand owed in terms of your current liabilities, the business has 4 rand 10 cents worth of current assets. So you're probably thinking, this is obviously very, very good for liquidity, but hang on, is the business maybe selling too much on credit? Or is the business overstocking, over-purchasing stock, and the stock levels are quite high? Maybe the business is, or maybe the business has too much of cash in their current account that is obviously sufficient to pay current liabilities, but can the business consider withdrawing some of the cash from their current account and maybe depositing this into a fixed deposit account? So those are some of the options that the company has if this ratio is a bit too high. Asset test ratio, again, the asset test ratio, if we compare 2007 to 2008, it has improved, and this ratio also indicates that the business will be able to meet its short-term commitment. For every 1 rand of liabilities or current liabilities owed, the business has 2 rand 50 cents worth of current assets. Your stock turnover rate is your third liquidity ratio. So if we look at stock turnover rate, 2007, it was 8 times per annum. 2008, it's now 12 times per annum. So this business is selling stock at a much quicker, at a much faster rate, which is absolutely brilliant for liquidity. Your next liquidity ratio, the fourth ratio, is your debt collection period. We spoke about this earlier on. There's absolutely no problems here. Okay, debtors are obviously settling their accounts on time. And then finally, your last liquidity ratio is your, let's just put that up a bit, is your creditors payment period. Your creditors payment period, if we look at this ratio, the business is obviously taking a bit more time to pay their creditors. It could be possible that the business negotiated a better payment period. So from 60 days, they could have negotiated 90 days. But if you compare this to your debtors collection period, there's no need for this 90 days. The business can actually or try and maintain a payment period of 60 days. Okay, right, let's now go back to your answer sheet and let's look at more or less how we're going to comment on liquidity. Right, if we look at our comments from the information that we've just examined, the liquidity is generally satisfactory. In other words, the business will be able to meet its short-term obligations. And then the question, if we go back to the question is asking us to quote 3 relevant financial indicators, 3 relevant liquidity ratios. Remember, you had 5, so you can quote any 3 from the 5 I've chosen. Your current ratio, so I've mentioned the ratio, and then what the ratio is. 2007, if we compare 2007, it has improved 2008. I've done the same for your asset test ratio, quoted the ratio, what the ratio was for 2007. It has now improved to 2,46:1 in 2008. And then the last liquidity ratio that I've used, stock turnover rate, from 8 times per annum, it has now improved to 12 times per annum. Okay, remember guys, you could have used in your answers your debtors collection as well as your creditors payment period as well, because they are also liquidity ratios. Right, let's move on now to our next question. For our next question, we are asked to calculate and comment on the solvency for 2008. And as you can already see, I've already started writing in my formula. Let's just carry on with the formula. Let's change my pen quickly. Solvency, we are comparing total assets to total liabilities. Right, again, we're going to go back to our balance sheet. Let's quickly find our balance sheet. And in our balance sheet, very easy to pick up total assets, because there's our assets. And our total assets for 2008 is an amount of 1,867,540. So there's my total assets. I'm going to now compare my total assets to my total liabilities. Now, on the face of the balance sheet, I will not find total liabilities. But what is total liabilities? Total liabilities is your non-current liabilities plus your current liabilities. That added together gives me my total liabilities. So on the face of the balance sheet, there's my non-current liabilities, 150,000, and below that there's my current liabilities, an amount of 60,500. Right, so let's now complete this ratio. So my total assets, I've already calculated my total assets, not calculated, sorry. I've already got my amount, so there's it up there. Okay, so our total assets, an amount of 1,867,540. There we go, there's our total asset amount. And then our total liabilities is made up of two amounts. Our non-current liability, which was that long-term loan, an amount of 150,000, plus our current liability. Let's go back to your balance sheet. Your current liabilities, which was 60,500. Okay, so plus 60,500. Right, let's add up our non-current plus our current to calculate our total liabilities. So if we add up, we're adding up 150,000 plus 60,500 to get a total liability of 210,000. Right, so our total liabilities, an amount of 210,500. I'm just going to bring down my total assets, 1,867,540. Right, remember, right-hand side must always equal to 1 in your ratio calculations. So I'm going to divide by 210,500 to get my 1 on the right-hand side. Again, guys, whatever you do on the right-hand side, you do on the left-hand side. Divide by 210,500. Okay, so let's get our calculators out. So we've got our assets, total assets 1,867,540 divided by 210,500. And we're getting 8,87. If I round that off, I'm going to round it off to 8,9. So let's fill that in. So we've got 8,9. Okay, let's just fix this quickly. 8,9 is to 1. Okay, so that is our solvency ratio. Now, if we comment or the question does ask us to comment on solvency. Can you see for every 1 rand of total liability, this business has 8 rand 90 cents worth of assets. So the business is absolutely solvent. So when you are commenting, guys, I don't have time to write the comment down for you, but your comments would be more or less the following: the business is solvent, the business will be able to pay off its total liabilities, or you could state for every 1 rand owed, the business has 8 rand 90 cents worth of assets. Right, let's move on now to our next question. Question 1.4 reads as follows: the company's directors feel that the shareholders should be very happy with the returns, with the earnings, and the dividends of the company. Quote 3 financial or 3 relevant financial indicators, and again here they're talking about your actual ratios or actual percentages to support their opinion. Now please remember, grade 12s, always read your entire question. They are not asking you whether the shareholders will be happy or not. They are telling you that they feel that the shareholders should be happy. Quote relevant ratios indicating or supporting their opinion that the shareholders will be happy, will be satisfied with the returns. So let's now go back to our information and let's look at which ratios will indicate to us that our shareholders are indeed happy with the performance or with their returns. Right, so let's go to our information, and we're now looking at information 2, because that's where our financial indicators are. We are looking at returns. Sorry, not risk, but returns. So further down, there we go. Right, so our returns, our ratios, percentage return on average shareholders' equity. Then we've got percentage return on total capital, net asset value per share, Then we've got our dividends per share, and finally our earnings per share. And if we look at these ratios, let's look at percentage return on average shareholders' equity. 2007, the return was 25%. 2008, this return has increased to 33.3%. So obviously guys, your shareholders will be extremely pleased with this return. Let's look at your net asset value per share. Net asset value per share, the shares were worth in 2007 213.6 cents. 2008, the value of the shares has now increased to 217.3 cents. Again, this would please your shareholders, because if they have to sell their shares, they're obviously going to get much more for their shares. Another ratio that indicates that your shareholders are indeed satisfied with the return would be your dividends per share. Dividends per share, 2007, your shareholders were receiving 10 cents for every share that they held. It has now increased to 20 cents. Okay, so these ratios are indicating that shareholders should in fact be satisfied, should in fact be happy with returns, with dividends, with the net asset value per share. So if we go back to the question, and let's now look at the answer. There we go. You're going to quote any three relevant financial indicators. We've spoken about the financial indicators and the three relevant ratios that are used. There has been an improvement in percentage return. So from 25%, it has now improved to 33.3%. Then again, an improvement, as we saw, in earnings per share. So from 55.2 cents, it has improved to 68.9 cents. And then the last ratio that was quoted, there's been an increase in DPS. DPS is your dividends per share. So from 10 cents, the shareholders for 2008 received 20 cents per share. Okay, what I want to do, grade 12s, is, I know we've got 1.5, but I want to go to 1.6, look at maybe 1.7, because we're going to run out of time. So let's quickly look at 1.6, because this is often asked in your exams. Rather than issue more shares, the directors are considering taking out additional loans. Quote two relevant financial indicators, again, either actual ratios or percentages, to support their opinion. Right, so you've got the directors, and they require more capital. So instead of issuing more shares, the directors want to take out additional loans. And what the question is asking you, quote financial indicators that will support their opinion of taking out more loans rather than issuing more shares. So again, let's go back to the information or the table that has our ratios set out. So let's go to, there we go, there's our table. And let's look at the ratios that are relevant for risk. Okay, there we go. There's our ratio relevant for risk. Right, what I want to do, guys, is just quickly, I just want to take out some of this so that we don't muddle up our ratios. Okay, let's take this one here out as well. Right, ready to start. Now, if we look at our debt equity ratio, your gearing ratio, we've already concluded when we were looking at the information that this business does not rely much on borrowed capital. So if we look at the ratio itself, 2007, our ratio was sitting at 0,1:1, so the business was very low geared. And then if we look at 2008, as per our calculation, this ratio has decreased. In other words, it's now 0,09:1. If we look at these ratios, what does it indicate? Again, that the business is low geared, low risk, and it is very easy for the business to obtain future loans. Another ratio that is also important, that also indicates that the business should take out or can consider taking out an additional loan, would be our percentage return on total capital employed. Right, if we look at our return, we've got a return of 44,3%. So that is the return on total capital employed. Employed meaning capital that was used. Now remember, capital, you obtain capital either by selling shares or taking out additional loans. The cost of taking out an additional loan is obviously paying the interest, paying back the interest. And if we go to our information, we're looking at our income statement earlier on. The interest on loan was sitting at 13% per annum. So if we go back to our ratio or our percentage return, your percentage return is 44,3%. So we've got our interest being 13%. The return is 44,3%. So can you see the return is much more than the interest that you are paying. Therefore, it is very advisable for the company to take out additional loans, because they obviously are capable of paying back the interest and at the same time increasing the return, the rate of return. So let's now go to the answer itself. Using these two ratios that we've spoken about, we've got return on capital employed. So your return on capital employed for 2008 was sitting at 44,3%, and your current interest rate is 13%. In other words, like I mentioned earlier on, the return is much higher than your interest rate. And then the next ratio that indicates that it's very favorable for the company to take out an additional loan is your debt equity ratio, because your debt equity ratio has decreased from 0,1:1 to 0,09:1. In other words, the company is extremely low geared, and because the company is low geared, it's obviously low risk. There's low risk in terms of the amount of loans that the company has obtained. Right, let's quickly look at our last question. 1.7, the auditors have told the directors that directors' fees must be shown separately in the financial statements and not as part of salaries and wages. The directors do not want to change this. What is your opinion on this problem? And then they're asking you to explain for 3 marks. Okay. Right, if we look at directors' fees, salaries and wages, both are considered to be operating expenses. So if you had to examine an income statement under operating expenses, you would normally have your salaries and wages, and below salary and wages, you would find directors' fees. Okay, now what the company or what the directors want to do is they do not want to disclose directors' fees, but instead, under your salaries and wages, they want to include the director's fees. So for example, if your salaries and wages is an amount of 200,000 and the director's fees is an amount of 1 million rand, they want to disclose the total 1,200,000 under salaries and wages. Right, so what your directors want to do is they want to show salary and wages an amount of 1,200,000. In other words, they don't want to show this separately. That 1 million rand, that's what the directors are earning. Now remember guys, in terms of the King Code, directors need to be transparent. Transparent is more or less like an open book. Don't hide anything from your shareholders. Why? Because your shareholders are the ones who voted for the directors, who decided on the directors who are going to run the company at the AGM, the annual general meeting. So the shareholders have a right to know exactly how much directors earn. Right, so in terms of your answer, transparency regarding what the directors earn. I just explained transparency. It's an open book. You need to be, the shareholders need to know exactly what the directors earn. And then, like I just mentioned, shareholders have a right to know what your directors earn. Okay, grade 12s, we've come to the end of our question on ratio analysis. We've run out of time. Please remember, grade 12s, you need to know your formulas. You need to be able to calculate ratios. And the last thing that you want in an exam, in a test, where you can't complete a calculation simply because you haven't learned your formulas. So please remember, make sure you learn all your ratio formulas. From my side, good luck, grade 12s. Practice, practice, practice. Until next time, goodbye.